Hello, and welcome to our podcast, Truss Talk. I'm Jason Nichols, partner at Truss Financial Group. I've spent my career finding ways to use data and alternative lending products to help entrepreneurs, people just like us, get the capital they deserve.
And I'm Jeff Miller, CEO at Truss Financial Group. I've been in the mortgage trenches for over 20 years, and if there's one thing I've learned, it's that the best borrowers are often the ones the big banks understand the least.
Jeff and I founded Truss Financial Group specifically to serve the square pegs who don't fit into the round holes of traditional banking.
We're recording this in 2026, and the lending landscape has changed. It's no longer just about having a high credit score. It's about how you document your success. If you're self-employed, an investor, or a business owner, you're in the right place.
Today's episode is a big one. It's the question we get asked at a lot of networking events. The question always goes, is it actually possible to write off everything on my taxes and still qualify for a mortgage?
Yep. Most banks will tell you no way. Today, we're going to tell you exactly how we at Truss Financial Group say yes. Jason, let's paint the picture. It's tax season. An entrepreneur has a killer year. His grossing may be $700,000 or $800,000. Their CPA does a fantastic job and finds every legal deduction possible.
Right. They write off the truck, the home office, the travel, the equipment depreciation. On paper, that $800,000 revenue turns into $45,000 of taxable income. The entrepreneur is happy because they aren't handing a fortune to the IRS.
Fast forward to October. That same entrepreneur wants to buy a $1.5 million home. They walk into a big-name retail bank, and what happens?
The bank's underwriter looks at line 31 of their tax return and says, "I'm sorry, you only make $3,700 a month. You can't even afford the taxes on this house, let alone the mortgage."
It's a slap in the face. The bank is essentially telling a successful business owner that they are poor because they have a smart tax strategy.
And here is the 2026 reality. Big banks use automated AI underwriting systems that are programmed to look only at net income. They don't see the $200,000 sitting in your business checking account. They only see what you told the government you kept.
So, Jason, how does Truss Financial Group fix this? Because we don't want people to stop taking their legal deductions.
Exactly. If you are self-employed, by any means, do not fire your CPA. The fix is our bank statement loan program. This is the flagship for self-employed borrowers at Truss Financial Group.
Jason, can you tell them the tax return rule?
It's simple. We don't look at them. For this program, your tax returns are irrelevant. Instead, we ask for 12 or 24 months of your business bank statements.
We look at the deposits, right?
Exactly. We add up every dollar of revenue that hit that account over the last year. That gives us your gross monthly income. We might apply a standard expense factor depending on your industry, maybe 50% for a contractor or only 10% for a consultant. But we are qualifying you on the cash flowing through your business, not the number your accountant sent to the IRS.
This allows a borrower who shows $40,000 on taxes to qualify as if they make $400,000. It's the exact same person, just a different way of measuring their ability to pay. Now, Jason, some businesses are more complex. Maybe they have multiple LLCs, or they've had a down year in 2025, but 2026 is looking huge. What else do we have in the toolkit?
That's where the P&L only loan comes in. If your bank statements are messy because you're moving money between entities, we can have your CPA prepare a simple profit and loss statement for the last 12 months. If that P&L shows you're profitable now, we can use that as the primary income document.
We also have asset depletion. This is huge for the wealthy but tax-poor client. If you have $2 million in a brokerage account but your business income fluctuates, we can convert that $2 million into a monthly income stream for the sake of the loan application.
It's about looking at the whole picture. At Truss Financial Group, we aren't looking for reasons to say no. We're looking for the story that proves you're a safe bet.
The bottom line for today's Truss Talk is this. You don't have to choose between a great tax strategy and a great home. You can have both.
But you have to work with a lender or broker who understands the entrepreneur's life. If you're self-employed and you've been told you need to show more income for 2 years before you can buy a home, they are giving you 1990s advice.
Don't pay the IRS more than you owe just to get a mortgage. Call us instead. Send us your last 12 months of bank statements, and let us show you what your real purchasing power looks like.
You handle the business, we'll handle the bank.
Thanks for joining us for this episode of Truss Talk. If this helped you, share it with another business owner who's stuck in mortgage jail.
Thanks, guys. We'll see you next week.